Hello there and welcome to the week ahead with me, Fiona Cincotta, Senior Market Analyst at City Index. So just before we get going, I'm going to ask you to read the risk warning. Just put myself on mute here and you can take a moment to read through that. Thank you. Okay, so what we will do, as we usually do, is just get have a look at the City Index economic calendar. Here we go. Okay, so as always, what I do here, this is the economic calendar on the City Index page. We just filter it by the week ahead. And then we also filter by high impacting events. So we'll just take a look, see what events there are, which markets might be affected, and potential trading strategies surrounding those markets. Now here we go. So usually we go through this chronologically, but actually I'm just going to do it slightly differently this week because there is a couple of major events as far as the US is concerned, which will be the highlight of the economic calendar. So we've got on Wednesday the well, not only have we got ISM manufacturing PMIs, but we've got the Federal Reserve interest rate decision. We've also got on Friday the non-farm payroll results and also average and the IMS services. So there is a lot of focus on the US this week. And I think it's going to be really interesting because obviously the market is exceptionally focused right now on expectations as far as rate cuts are concerned, and when the Federal Reserve might start to cut interest rates and to what extent they might be able to cut interest rates. Now, we've had sort of mixed data so far this week, but broadly speaking, across Q1, we've seen several sort of upbeat surprises. We've also seen US inflation tick higher. Just to point out that this webinar is being done before US core PCE data later today. So that will be the latest sort of update as to how inflation is holding up, whether it's proving to remain sticky, whether we're seeing a cooling in inflation. But, you know, as far as data this week is concerned that we've had, we saw US GDP showing real signs of stagflation. In fact, we saw growth slow, more than expected, but we saw inflation, so the core PCE across Q1 was actually much hotter than expected. It rose to 3.7%, up from 2%. So that's obviously adding to this view that actually the inflation picture in the US doesn't seem really to be making much more progress. In fact, CPI data has been pointing to hotter than expected, or has come in, has increased for the past 3 months. So understandably, the markets are a little bit sort of cautious as far as what the Fed is expected to do. Now, this is the Fed rate cut expectations. We're now, you know, if we look out, this is for December, what the position is expected to be in December. And actually, you know, the market is, interest rates currently are at the 5.25 to 5.5%. There is a 20% probability being priced in the market that actually the Fed won't have cut rates this year. It won't cut rates this year. The bigger percentage is that they will have cut rates once by the end of the year, potentially cut rates twice as well. But so, I mean, we've seen rate cut expectations being pushed back really quite strongly over the past couple of weeks. And that's as the Federal Reserve's also sounded a much more hawkish, you know, as far as Fed speakers are concerned. There haven't been any this last week, but the previous week, because they've been on the blackout period, but the previous week, you know, we've had several Fed speakers, some, you know, much more cautious about cutting interest rates and saying, you know, there really is no urgency to move on rates. And with inflation still above the Fed's target, proving to be consistently sticky, then that does raise questions over, you know, whether the Fed actually does need to cut rates at all. And Fed Bostic, you know, he seems to be suggesting that maybe they won't happen at all, maybe just one. Federal Reserve Jerome Powell has also, you know, actually calmed down his dovish tones, actually sounding a little bit more hawkish as well. So what does all this mean for the markets? Just to mention, we're not expecting a rate cut we're not expecting any move in interest rates and the meeting next week. The market will be looking very closely at sort of expectations and commentary and whether we're seeing sort of a slightly more dovish, hawkish tone to Fed speakers. Now, this is the US dollar index. Interestingly, so we've had that really a strong run higher across March and most of April, getting to that high mid-April of 106.50. We have actually seen the US dollar just come off slightly. US Treasury yields still remain high, though they've risen to a fresh 5-month high. So, you know, there is potential for the US dollar to continue rising, particularly if we get that stronger than expected inflation data through today. And next week, if we get that sort of slightly more hawkish sound from the US dollar, that could potentially get the dollar back towards this 106.50 level. That's going to be a key level to watch to see whether bulls can break it up there. But that said, you know, we are in this little downtrend across this week so far. As far as support is concerned, this is a really key level here, the 105. That was the early April high. It's also just above the high here that we saw in February. So if we do get a break below that 105 level, then that's going to negate that near-term push higher and could open the door to the 200 SMA, which is down there at the 104 level. But as I said, if we get, you know, we can see just here that slightly longer wick on that lower candle does suggest that we might see that could be the end of the down rally or the down move. So yeah, if we do get a move above the 106.50, then we'll be looking at this level here, which is the 107.30, which was the October 2023 high. So just whilst we're, and also this is going to be keeping our mind in, we'll talk about the non-farm payroll whilst we're here, because, you know, if we get, for example, a more hawkish sounding Federal Reserve, and then we also get stronger than expected non-farm payroll figures, then that's going to be a double boom as far as the US dollar is concerned. Just as far as non-farm is concerned, in the latest non-farm payroll, job creation was actually much stronger than forecast. It was over 300,000, but we did see unemployment tick higher. So this is going to be, and wages rose steadily as well. So, I mean, things to be watching out for is that unemployment rate, is it continuing to rise? Wage growth, is that still rising? Is it rising steadily? Are we seeing sort of any jumps there? I mean, if we think about sort of, you know, the jobless claim figures, you know, jobless claim figures this week were, you know, strong. You know, we saw that the labor market is holding up well. Jobless claims fell to 207,000. So that's what to be watching. As far as markets are concerned, obviously this is the dollar that we're having a look at here. I think whilst we look at the dollar, it's also just useful to have a look at we'll have a look at gold as well. Now, obviously, gold has had an interesting run because it rose to this record high there of 2,430. And we did see another peak as well there at the 24th, 17. But again, look at those longer upper wicks, which suggest, you know, that buying demand at those upper levels was actually very weak. And we saw that sharp fall lower. Now, that actually brought the price out of overbought territory. So, you know, partly what that was a technical setup that saw the price fall, but also we saw the tensions in the Middle East, particularly between Iran and Israel, ease. You know, they were sort of on the brink of something much more serious, and they both just seem to have stepped back from that brink. So that took the risk premium off gold a little bit. We saw a reduction in safe haven flows, but anyway, we've seen this level round here just below 2300 hold as support, and the price is attempting to push higher. Now, if we get stronger than expected US inflation, then we might find that gold struggles to push above this rising trend line resistance by the end of the week. Also, if we get the hawkish sounding Fed, then that could also prove to cause struggles in gold's rise. But I think fundamentally, other drivers for gold include central bank buying and also this hedge against inflation. And given that inflation concerns seem to be swirling around again, that's sort of also supportive of gold. So I think there could be some potential upside. And we have seen this. We saw gold rise to these record highs, even as the US Treasury yields rose to 5-month highs, and as the US dollar pushed, as we've just seen, to those sort of 106 levels. So it's just because the US dollar is rising, that doesn't mean that gold can't either, although often we see gold come under pressure if the US dollar rises and Treasury yields rise. I think on the downside, the level to be watching here is 123 or 122.90. This is the lows that we saw this week. We do get a breakthrough there, then I think the next one to be watching out for is the 2222 level. On the upside, if we get a break above this rising trend line support, then we'll be looking back up to 2400. Now, I think whilst we're thinking about the US dollar and Treasury yields and Fed expectations, I think we do really need to have a look at what's going on with the US dollar Japanese yen. So as we can see, we've had this break over 155. We've just had the Bank of Japan's interest rate decision yesterday, or today, in fact. They left rates unchanged. They did sort of suggest that inflation may be hotter than originally guided for in the coming year. But then we had also Tokyo inflation overnight, which was much weaker than expected, just 1.8%, which sort of, raised questions about the Bank of Japan's guidance for inflation. Also worth noting, though, although the Bank of Japan guided for stronger inflation, they also guided for weaker growth. So they may struggle to actually hike interest rates even if there is hotter inflation. So at the end of the day, the net outcome has been a weaker yen. And sort of whether we see a further rise in this US dollar Japanese yen really depends whether we're going to see that continued rise in Treasury yields and sort of, expectations of actually inflation remaining persistent and sticky, and the Fed not being able to cut interest rates. On those circumstances, we could see this 160 level actually coming into focus. This was the line 155 that, it was perceived that Japanese authorities would step in to support the the yen, but actually they didn't. So the fact that they haven't does sort of raise questions whether they will at what level, whether they will around here or whether they'll wait for 160 now. Obviously, I think with the Bank of Japan meeting, it did make the situation quite complicated for the Japanese authorities. But look, this is similar to what happened here, and if we think about it, this is when we had that CPI US inflation data. That's what's stickier than expected, and it drove the rise higher. And this is just around the inflation data now, which is driving that rise higher. So yeah, levels to be watching out for. Obviously, they're going to be jitters about intervention, which could make it sort of traders cautious. On the downside, support 155. We've got some minor support here around the 153.70, and then major support here at 152. So just moving on now, I think whilst we stick with the US and what's going on in the US, It's also worth mentioning that obviously US earnings season is still going on, and we do have we've got earning reports from the major ones to be pointing out for next week are clearly Apple and Amazon. They come as the Magnificent Seven sort of, continue to release earnings this week. We've had quite a few. We've had Teslas now. We've had mixed earnings and mixed responses. Okay, sorry about that. I think I just had a slight technical hiccup there. But no, so we were talking about earnings season. We've had several US Magnificent Seven companies report this week with mixed responses. Meta got absolutely crucified for the ending its year of efficiencies, despite its earnings and revenues beating expectations. The market's got a little bit jittery about its spending plans for the coming year. And then we've also had Alphabet and Microsoft. They've reported overnight, and we've seen a really encouraging reaction to those figures. So there's been quite a lot of volatility that's been that's come about on the back of earning figures from these big from the Magnificent Seven stock that we've had so far. Now, as I said, we've got Amazon, which is on the 30th of April. And we've also got Apple. But first of all, Amazon, what are we expecting? EPS of 0.84, and that's on revenue of 142.6 billion. Very much the focus is going to be on Amazon Web Services, which really the market will be looking for double-digit growth, and I mean that is a big driver of growth at Amazon, so it'll be very much in focus. And advertising as well is going to be a key focus, and that's expected to grow 23%. Just worth noting that upside surprises on EPS, Amazon's come through on 4 of the past 5 quarters, and it has beaten in 5 of the past 5 quarters on revenue. Then we've also got Apple, as I mentioned. I'm just we'll have a quick look at the Amazon chart whilst we're here. Look, you see, this is the caught perfectly on the 100 SMA there, and it's rebounded higher. We've got that long lower wick, which could suggest that that's the end of the downtrend. We've got an opening here expected around the 180 level. Going into next week, if we do get some more strong numbers or Amazon does impress, then watch out for the 190 on the downside. This is going to be the level at 167, which is needed to take out to get a lower low. Then, as I said, we've also got Apple, who's reporting. They are expected to report EPS of $1.50, and that's on $89.8 billion revenue. China is going to be very much in focus here. The China iPhone sales are expected to have fallen around 19% in the first quarter, which is going to be, well, bad news as far as Apple is concerned, given that China is such a huge revenue driver. There'll also be potential of an increase in the share buyback by 90 billion. Also, Vision Pro sales are going to be in focus. But, at the moment, we seem to have this weak demand environment, which has not helped Apple's share price. It's down around 14% year to date. So it does look like it's trying to establish a recovery low there around the 165. That needs to be taken out in order to get a lower low. On the upside, looking for a rise above the 178 to really get a higher high in. But let's just see what all this means for the NASDAQ. NASDAQ, look, it sold off really quite sharply from, we had the all-time high, we had some consolidation around here, then it broke down, falling to a low there of just around 17,000. We've seen the recovery from 17,000. Long lower wick on that chart does suggest that there might be some support, sort of solid support around that level. That's the February low at around 17,170. We're above the 100 SMA at the moment, really going to be looking for a move above 17,800 in order to extend that rally back up towards the 18,000 and sort of 18,450 all-time highs. So that's what we've got going on in the US, just so that we have a look at other points to be watching on the economic calendar as well. Look, we've got German inflation coming in. We've also got Eurozone inflation coming in, and we've also got German GDP. So just focusing here on, I mean, we've seen that German data has been showing some signs of improvement in recent data points have been sort of suggesting that the economy is starting to recover. Inflation is low in Germany. It's expected to remain low around that 2.2% level. And we've even seen sort of suggestions that the recession may be over, with sort of a stalling at 0% in Q1. Eurozone inflation is expected to be, so we've also got Eurozone GDP in there, I'm just watching that. So slightly stronger growth in Q1 than we saw in Q4 of last year. Inflation, again, is expected to be ticking lower. So let's just have a quick look at what's been going on with inflation in the Eurozone. Look, here we go. We can see that it peaked above that 10% and it's been steadily trending lower. Core inflation as well appears to be steadily trending lower. So that is expected to continue to be the case. Now, the ECB has signaled that it could cut interest rates as soon as June. We have heard that ECB members have suggested that they do want to see wage growth data in May before they take any decisions on rate cuts, because that has been sort of the area of concern for the ECB. This is just a look at the euro US dollar. Now, it has picked up. We've seen here it dropped to that 106 level. If you remember back to that US dollar chart, that is when the US dollar was also suddenly sort of, strengthening towards the peak, and then the US dollar came off. So as the US dollar has come off slightly, we've seen the euro increase. Now, this again is slightly to do with, this signs of the economy recovering. We've seen signs of PMI data has started to come through stronger than expected. We've seen German IFO business confidence. We've seen German consumer confidence come through more stronger than expected. ECB President Christine Lagarde has also said that there are signs of recovery, but these signs of recovery aren't expected to be enough to knock the ECB off track from cutting interest rates in June. We're expecting a 25 basis point cut. The question is, what's the ECB going to do after that? Because obviously they don't want to be moving sort of too far ahead with cutting interest rates whilst the Federal Reserve is staying pat. So anyway, the slow improvement in the economy, the weakness in the US dollar has helped the euro US dollar move up to this 107.25 region, where it's trying to break across at the moment. Now we see there's a slightly longer upper wick on that candle, which does suggest that buying demand at those higher levels has been weak. But if we think about inflation next week, if we get a cooler than expected Eurozone inflation, then we could find that the pair breaks back down towards those levels and looks back towards the 106.40 level, though this again does depend on the amount of strength that we're seeing in the US dollar and what's going on as far as the Fed is concerned, whether they're sounding slightly more hawkish. So if we see a more hawkish Fed and weakening in Eurozone inflation, then watch out for that 106.40 level and even the 106 level. If you find hotter than expected Eurozone inflation and we see perhaps a weakening in US non-farm payrolls, then maybe we could be starting to look towards that 108 level. That's also the 200 SMA up there. Just whilst we're on with this, let's also have a look. We've got data from China next week. I'm just going to rush ahead to that because I'm conscious the time is ticking. So we've got the Chinese manufacturing PMIs, which are due. Now, China has been, quite a key focus in recent months, just as there are signs that actually the manufacturing sector could be starting to recover. In the cakes and PMI data, we saw that the Chinese manufacturing sector increased or expanded at the fastest pace in 13 months, and business confidence was also at a 13-month high. So that's really encouraging signs. We're going to be looking for signs of that continuing. As we can see, this is expected to come in at 50.8, the manufacturing PMI. We've also got the cakes and PMI there at 51.1. Non-manufacturing's at 53. Again, we've seen that activity in the non-manufacturing sector, so the service sector, sped up in March to its fastest pace in 3 months. So these are encouraging figures. There is a sense that the recovery in China could be starting to move forward despite big concerns over the property sector in the region. Just let's watch whilst we're looking here at thinking about China, the Aussie US dollar. Now this is interesting because look at that. I mean, really long lower wick as it fell down here, indicating the end of the downtrend, and it has rebounded higher. Just looking to try and cross the 200 SMA right now at the 105.25 level. If we can get a really good sort of a close above there today, then we could really be looking towards the 105.65.80 level, 100 SMA, going on towards the 66 level. If we see US dollar weakness and we see stronger data from China, that could be really encouraging. Failure to break above there, look on the downside. There are some levels of support here at 64.88 and also here 64.40 or 50 basically, and that's the February low. The other one to watch whilst we're thinking about China, but also just generally with the US dollar and also with what the Fed might be doing, is oil prices. So we've seen oil has come off those 5 months highs. That was sort of part as we've seen the risk premium come off on oil as the sort of situation between Iran and Israel has sort of stepped back from the brink. But if we see strong data from China, and we do suppose we see perhaps any sense that the Federal Reserve is still planning on cutting interest rates, then we might see oil prices push up. This will be the number around the 85 level. That's where near-term resistance is. Above 85, it's the 87.75, but it's still trading in this uptrend that it has been in since the end of last year. We've got a couple of long lower wicks on these candles here, suggesting that there wasn't much selling demand around that 80 level. So that is all from me. I've just seen the time. It flies every week, but thank you very much for your time, and I look forward to catching up with you again next week.